Remember last month when we discussed what's a mortgage? Well, this is part 2. Let's continue off of our What's a Mortgage education we started last month and go into a little more detail. Since you now understand amortization, let's discuss fixed rate versus variable rate. The interest rate on a fixed rate mortgage stays the same throughout the life of the loan. Another way to say this is a fixed rate mortgage has an interest rate that never changes during the entire loan term. As a reminder from the last video, some of the principals paid off each month, making the interest a little less with each payment. At the beginning of the loan, most of the payment goes towards interest, with more principal being paid near the end of the term. Some pros with a fixed rate mortgage. Mortgage rate never changes. Monthly payment does not increase. Good for when mortgage rates are low. Peace of mind. Some cons of a fixed rate. Higher rate compared to a variable is typical. Higher monthly payment, and to take advantage of falling interest rates, you will need to refinance your loan. Now let's discuss a variable rate, or adjustable rate mortgage, referred to as an ARM. With this type of mortgage, the interest rate applied varies throughout the life of the loan. With an ARM, the initial rate resets at yearly or monthly intervals. Here are some examples of terms. 5-1 is a fixed rate for 5 years, followed by a variable that adjusts every year. Our final example is a 5-5 ARM, which is fixed for the first 5 years and then adjusts every 5 years after. The interest rate is based on an index plus a margin. Many of you have heard of the LIBOR, the London Interbank Offered Rate, when reviewing variable mortgage terms. This is sunsetting and going to the Secured Overnight Financing Rate, the SOFR. Is that how we pronounce this? Industry friends, help me out. Another way to look at a variable rate, an ARM can save you money because the initial interest rate is lower than a fixed rate mortgage, but your rate can adjust higher. So please educate yourself. Pros are lower initial rate typical than a fixed rate, lower initial monthly payment, can buy more house for the same payment. Some cons to watch out for: unpredictable when rates can change, harder to budget as monthly, yearly payments can change. Many types, so need to understand rate caps, initial rate, and margin. Benefit if rates fall, detriment if rates rise. Feel free to DM me your mortgage questions. My team is here to help, from the basic to the complicated. And as always, follow me at Leading Mortgage with Gratitude.